Hi, everyone. My name is Josh Brown, founder and CEO of Ritholtz Wealth. And today we're going to tell you the incredible and true story of how Nvidia's employee shareholders became millionaires and multi-millionaires through the company's employee stock purchase plan. I'm joined today by senior advisor and our in-house expert on stock-based compensation, Joey Fishman, who has spent the last 9 years advising Ritholtz Wealth clients, many of whom work at startups or firms that heavily utilize stock options and equity comp plans. Joey, thanks for being here today.
My pleasure. Thanks so much for having me.
And you are in Bend, Oregon at the moment. Is that right?
Bend, Oregon. That's my hometown.
Very cool. All right. Let's start with the basics, just for people who aren't completely familiar with the subject matter, so everyone's starting on the same page. And then we'll get a little bit more specific into Nvidia. What are the basic things people should know about employee stock purchase plans, or ESPPs?
They are a benefit per se. They're not necessarily like an equity comp. It's not part of your compensation to receive ESPPs. It's an elective. So it's similar to like contributing to your 401k plan. You have the option, but not the obligation to purchase company shares. And essentially the selling point on it is that each or every 6 months, you're allowed to accumulate enough cash from your salary that you then set aside to purchase up to $25,000 a year worth of employee stock. The way in which Nvidia does it, what makes it uber, desirable, is that there's a 6-month period between when you originally start setting aside money to buy the ESPPs until when you actually pay for them. And what Nvidia does is they take the lowest trading point between when the start of that period began or when the end of that period finished, and they take that, whatever's lower, and then discount it by 15%. So for folks that have had the option or had the ability to participate in this over the last 10 years, they've accumulated roughly $25,000 a year worth of Nvidia stock, paying 85 cents on the dollar for it at each time. And they've had this explosive growth going forward. And so it's not unusual for folks to call us that have been in Nvidia for years. And hey, I've been buying ESPPs for the last 7 years. And now I'm looking at, $11 to $10 million worth of company stock that I now need to figure out how to liquidate.
Wait, this is incredible. So if you're an Nvidia employee, they give you the option to use your own salary, part of your own salary, to buy up to $25,000 worth of Nvidia each year. And you can buy, they'll give you the discount based on where the stock had been trading during the period in which you put your own money in.
It's called the look back period. And they take the past 6 months and look at the lowest trading point between either the beginning or the end. And so whichever is the lower trading point, they then further discount it by 15%. So it's produced like these amazing returns over the last number of years.
Could you take a guess at what percentage of Nvidia's peer companies are offering something like that? Is it very widespread or rare?
Most are, like in the tech space, especially in the large cap tech space. It's pretty, it's commonplace for most tech firms to offer clients employees access to ESPPs.
How many of them are offering this 15% discount look back period?
Not all of them are as lucrative as what Nvidia offers. There's Microsoft and Apple, they're up there, but not everybody is as generous as Nvidia is.
Now, why would a company do that? Is it just about gaining and retaining the top talent in the field, or is there some benefit to the company in providing something like this?
I think employees tend to be more sticky. So our experience is that when folks are calling in trying to understand, like, how do I unwind this? It's usually people that have been there for many, many years. And like they've believed in the company, they've had their own equity compensation as part of their salary, but they didn't feel like that was enough exposure to the growth that the company was delivering. So they wanted to further invest by taking parts of their own salary to then dedicate to the opportunity of buying the ESPPs.
All right, we have some charts. Let's dig into some of the gains that we're talking about for employees. In the first chart, I'm basically showing you Nvidia's performance since inception. This has been the best performing stock in the Russell 1000 since coming public, I think in 1999. I think most people would probably guess that that's been the case, but maybe they didn't fully understand the extent to which the stock has performed. Nvidia's total return over this time period is an annualized 37% growth rate, which works out to a total return of 352,756%. And of course, as of the time of this recording, not only is it the best performing stock over the last 25 or so years, it's the largest stock in the world at the current moment. This has been a pretty extraordinary wealth creation vehicle, not just for shareholders, but for employee shareholders. And we may never see anything like this again, quite frankly, but there are a lot of great stories out there.
Yeah, there are. I mean, Microsoft during the heyday, during the internet bubble, I mean, it was in the penalty box for about 7 years thereafter, 10 years thereafter, but it just came roaring out of the gate over the last number of years. So Microsoft stock is probably, or ESPPs is probably a close second, along with Apple, to delivering like outstanding performance. But you're right, like Nvidia has just been an absolute moonshot, and it's delivered like wealth just unimaginable.
Yeah, and I think it's worth pointing out the employees have helped to generate this wealth for themselves, because what this really is a story of profit growth. Let's put up this next chart. What we're showing you here is Nvidia's earnings per share growth versus the other top 5 best stocks over the last 20 years. So included here is Netflix, Apple, Monster Energy, and Booking Holdings, which is the parent company to a lot of your favorite travel sites. These have been the best earnings growth stories, in addition to be among the best earnings growth stories, in addition to being among the biggest wealth creators for shareholders. So Nvidia has grown its market cap from $500 million to $3.25 trillion since inception. And obviously this comes along with stock price growth. But really, if you think about just this period this year, from January through November of 2024, that's $2 trillion in market cap growth in the last 11 months. So not only has it been an incredible performer over the last 20 years, just in the last couple of years, we're talking about wealth creation of just an amazing magnitude. What do you think, Joey?
I mean, it's almost like the municipal bond market blooming up overnight. I mean, the municipal bond market's $3 trillion, so this is not too far off.
Yeah.
This is amazing.
Yeah. One more here. So I found this really interesting. This is Nvidia employees in the left pane, are 29,600 total employees, and you can see that line just hockey sticked after 2019 in the AI era. It has just gone ballistic. Revenue per employee, though, is also hockey sticking, which means they're not just adding people, they're adding people who are in turn helping them to generate an ever-increasing amount of revenue. They're at $2 million in revenue per employee, which without having a table to show you comps, you could take my word for it. That's a very high number. And then the final pane on the right, this is the annual stock-based compensation. Joey, what does this number mean? Break this down for us.
This is the annualized amount of compensation that's given to employees. And to sort of pull on a thread, you had mentioned it kind of hockey sticks from 2019 on. The golden ticket was to be hired in 2014, where you're collecting both incentive stock options at a really, really low strike price. You're buying the ESPPs, and before you know it, on that revenue per employee just absolutely just rockets higher. So too does the stock price. And just as much as folks have crushed it in terms of ESPPs, it's probably that genre or that vintage of folks that were around in that 2014 to 2016 era that are also sitting on just oodles and oodles of wealth from Nvidia.
So in 2022, Nvidia distributed $2 billion in annualized stock-based compensation. The following year, $2.7 billion. This year, $3.5 billion. That number seems like it's on its way to $5 billion in annual stock-based compensation. So you can imagine the sort of individual household wealth that is being created for, to Joey's point, earlier employees of Nvidia who stuck around.
Yeah, and like the most recent iteration of Nvidia's stock plan, they're not giving out option contracts anymore that don't have like the leverage to goose those returns up, the same way. But they are
Yeah.
giving out RSUs, so restricted stock units, and those are a little bit easier to deal with and understand from a tax perspective. But the benefits for an employee of someone who now is in receipt of these is at the end of the day, you're guaranteed at least something with an RSU or restricted stock unit. Whereas your earlier colleagues that may have been there for the last 9 years, when they were receiving option contracts, they weren't guaranteed anything. So it's a little bit of a different animal now for new employees. It's a lot lower risk than it once was, but the opportunity set is still magnificent.
Let's do ESPPs versus regular equity comp versus RSUs and ISOs. Let's define some terms so that people understand exactly
Sure.
what's happening here.
Incentive stock options or ISOs, they have favorable tax treatment and they're typically reserved for early in the company's history when they want to incentivize people by giving them the potential leveraged exposure through equity compensation. It's usually given through what's called incentive stock options because if you can thread the needle on meeting all of the tax obligations, when you do end up selling, it's at a lower tax treatment than you otherwise would be paying. As time goes on,
Right.
they switch to RSUs, but most of the folks that probably started early on, they were the beneficiaries of incentive stock options.
So you say that for the most part, these are issued earlier in a company's lifespan. I'm guessing they're extremely favorable to the employee who is being lured away from a more established tech company. Why would I leave Apple to come to Nvidia? Why would I leave Intel to come to Nvidia is probably a more apt example. Of course, nobody knows what the stock price performance will be over the next
Yeah.
10 years, but the ISO is a strong enough incentive to make people want to take the risk of joining Nvidia at that time.
Totally. So with regular equity
Okay.
comp, that's an RSU, you're lucky if you get a 1 or 2x, on the result. But with an option contract, you can effectively get 10, 20, 30x on, relative to your strike
Okay.
price. So it's an enormous moneymaker if it sticks, if it works.
Okay. Most employees are more familiar with RSUs or being offered RSUs as opposed to ISOs,
These
especially
days.
as a company is at a more mature stage. Okay, tell us what RSUs are and how they work.
So restricted stock units, they are given out to employees that are not yet at the senior level. And essentially, it's part of your compensation package. So you're going to get X salary, and we're also going to grant you, let's just say, 100,000 shares or $100,000 worth of Nvidia stock. And the way in which that process works is that it's on a vesting schedule. So it unfolds over 4 years, but the first year you have to wait 12 months. It's called a cliff. After that 12-month cliff expires, you get the first 25% of that grant. Every quarter thereafter, you're going to be gifted or you're going to be granted, you're going to vest 6.25% for the next 36 months. So what ends up happening is that after that 4-year completion period, you have the effect of what $100,000 worth of RSUs at the time that you were granted them, whatever they're worth now. But this is essentially what's part of your compensation for working at Nvidia.
So you get the upside over that first 4-year period, but not until you've been there for 12 months when they make that first quarter of your stock grant. But basically, this is a tool to not only incentivize people to come work there, but to stay.
Exactly.
And I think keep employees, somewhat happy and focused on helping to build the prospects of the company for the future. It's a way of socializing the wins of the business, and not just the individual achievements of the employees, which I think is important.
Absolutely. It's every time that we talk to someone who has access to RSUs and ISOs and all forms of equity compensation, there's a certain level of maturity that I think that they have versus other folks who don't have access to this are not. They tend to
Right.
treat their job like they're an owner.
We hear a lot about business owners wanting their employees to act like owners. This is a really good way to help accomplish that.
Yeah. Yeah.
Let's take a look at the gains in the Nvidia ESPP. So this is the results of being enrolled in Nvidia's ESPP since 2015. Joey, could you walk us through this graphic and what we're showing people?
Sure thing. So what we're doing is we're showing you the cost basis. Let's say you've been investing in ESPPs for the last 10 years. So you have a notional investment cost basis of $250,000. Without the 15% discount that's applied every 6 months, and that's applied for the lower of the trading prices. Moving that off to the side, you'd have about $11.5 million accumulated just by buying ESPPs without the discount over the last 10 years. With the discount, it's about 13.5 million, which is about a 17, almost 18% spread. It's phenomenal. Like there's no other company on the planet that has delivered these types of returns for ESPPs or equity comp for that matter.
Right. So look, you would be happy with either of these outcomes. If if you had spent 10 years and $250,000 out of your own salary to buy stock, even without that look back discount, you're up 4,503%. Had you done so, though, the way Nvidia does it and gotten that look back discount, 5,314%.
Yeah.
And that's a difference of more than $2 million bucks in actual ending dollar value. So you can see what the benefits of that feature have been pretty extraordinary. You mentioned that Apple is a close second in delivering ESPP performance over this period, but still, it's a close second only because no one else is even close.
Exactly.
But you mentioned they still trail Nvidia by a pretty wide margin, which I thought was interesting. One of the other things that you mentioned is that when you walk employees through the benefits of this, the next question is for a financial planner. Okay, so I participated, I did really well. When do I sell? Or how do I sell without destroying myself on taxes? And I think that's where your expertise comes in, and what we do here at the firm is important. Talk a little bit about your experience in working with employee shareholders of Nvidia and other companies.
This is a really, really good topic. Sequence of return risk is an underappreciated discussion that isn't really talked about as much as and it really well should be. So it's not enough to just take a multiple and say, hey, I spend $200,000 a year. And if I'm a 50-year-old guy, I want to make sure I have 40 years in the bank. So I'm just multiplying 40 times 200. That effectively is being like your takeout number, or that's the number you need to never have to worry again. It doesn't necessarily work like that. And so like in the case of Nvidia, we've done some analysis that let's assume that the stock price goes from 60% annualized volatility down to 40% annualized volatility. Even then, even under that scenario, like there's still a reasonable probability that if there's a multi-year, if there's like a multi-year downtrend or a multi-year, decade where prices are just beat to crap and you're still pulling on that $200,000 a year, there's an overwhelming probability that you'll be broke. And so the discussion is not necessarily
which is by the way incredible to imagine.
Yes,
but
yeah.
entirely possible if the sequence of returns doesn't augur well. Like if we get into a certain type of market environment in which you're trying to withdraw funds, you may not be in a great position based on where prices are.
Exactly. I mean, so there's a reasonable probability that you'll find yourself at one point in time down 50 or 49% in Nvidia. The question then becomes, well, how long does that last? The longer it's down, the more that you draw on it, the more the probability is that you might find yourself eating mustard sandwiches. So part of the work that we do is helping you right size your spending to account for that sequence risk, and then making sure that like come hell or high water, regardless of what happens, you'll be okay. And then from there, we can start planning on, well, what would need to happen? How much would markets have to appreciate? How much would your equity position have to appreciate before you can safely spend more money and not face the probability of reducing your quality of life?
Why don't you take us through this next chart, which is showing the amount of AUM or assets required to live off the principal without selling the Nvidia stock at various future return expectations. what is this comparison that we're looking at?
Yeah, let me unpack this for you. So essentially what we're assuming here is, let's just say you have a 35-year time horizon. You want to spend 200 grand a year. You're going to have a 3% inflation kicker or personal rate of inflation. We're going to include taxes in those results. And essentially, we're giving the benefit of the doubt to Nvidia and saying, listen, as this guy matures longer, it'll go from 60% annualized volatility down to 40%. So we're giving that. And then we're assuming that going forward, like the next 35 years for Nvidia, will annualize 5%, 7%, 9, and 11. We're then comparing that to just a regular 60-40 portfolio that only has about 15% annualized volatility. And the takeaway from this chart is that you can hope that over the next 35 years that Nvidia delivers 11%, but you can also buy or invest in a 60-40 portfolio returning 5% for the very same amount of money. So in other words, you can hope that you have $8.2 million. You hope that over the next 35 years, Nvidia is going to return 11%, taking into account it's going to have 40% swings in volatility on an annualized basis. Or you can invest that very same amount into a 60-40 portfolio and expect 5% future returns and handily achieve your goals and objectives. So the way to look at this is that, like, volatility is a tax on your returns. It's a tax on your spending. The higher the whips, the more likely it is that you potentially could find yourself sideways and unable to meet living expenses. As ludicrous as that sounds with this kind of money.
Right. What the chart is not doing is saying that a 60-40 portfolio is superior to
Right.
Nvidia or will be or should be. It's not an analysis of the stock's prospects. What this is about is figuring out with a client, well, how much risk can you live with in this single stock or any single stock relative to what we can do when we diversify you, lower that annualized volatility, and still have you in a place where your financial plan can be achieved.
Precisely. When you've won the game, you have
Okay.
you got to leave the playing field at some point.
Right. Well, so I would imagine, especially at a company like Nvidia that's so dominant right now in its arena, it's not always the easiest decision.
That's
Okay,
right.
now is the time to diversify. What if the best is yet to come and I diversify too early?
That's right.
And then your job as the professional is to say, okay, that's one scenario. Here's another.
Yeah.
Which will you regret? Which will you regret more? And this is I guess, the science, but then also the art of financial planning and helping clients get to the right answers. Let's do this next chart. So this is for a younger employee who wants the option to live off the principal forever, but not the immediate obligation. And you call this a form of coast fire. So tell us what you're illustrating here.
Thank you. So Coast Fire, actually, I stole from Nick Majuli. But the term is essentially hey, once you get to around 40 years old and you find yourself where you have enough money that you can forever lock in your quality of life, this is essentially itemizing how much you would need to have set aside investing in a 60-40 versus investing in Nvidia. And the very same set of circumstances before, where we had the 35-year time horizon, this person has a 60-year time horizon. So obviously it costs more money, but the same thing holds true, is that lower volatility over time gives you more steady eddy results versus the agita that you're going to experience with being, in Nvidia and a 40% annualized volatility. So the point of this is to show that, like, once you raise enough money, you can forever lock in your quality of life. And this then gives you the option down the road to take maybe jobs that you wouldn't have taken before because the money wasn't there, but it's deeply satisfying to you.
Yeah, where it says 5%, 7%, 9%, those are different return scenarios?
They are, right. So
what's the right way to think about these?
Yeah, so if you were to prognosticate and say what do I think the annualized return of Nvidia is going to be over the next 60 years? If you chose 7%, so in order for you to retire successfully or tap out and never have to face the probability of running out of money, at 7%, you would need about almost $20 million worth of Nvidia stock to safely retire and not face that probability. Now, if you invested in a 60-40 returning 7%, the cost would be less, dramatically different, because the swings are nowhere near as vicious.
We've got one more chart, expected return assumptions by volatility regime. And this is once again a comparison between a diversified portfolio, which we shorthand as 60-40, versus a single stock. Tell us what's relevant here in this. There's a lot going on here.
There's a lot going on. The point of this here is just to show you what your experience could be like as an investor if you were to hold on to Nvidia. So the right side of this chart shows you the range of outcomes at the various return assumption scenarios. So like the deep red bar, that's the left tail, the high green bar, that's the right tail, and then the gray and the navy, that's the standard deviation in between. So at a 7% return, future return expectations, worst case scenario is you're down 47%. Best case scenario, you're up 94. Reality is likely to be somewhere between down 19 plus 44, something like that. Like that's your standard deviation.
Okay. Now on the left side, these bars represent the 15% volatility.
Exactly.
That's more common to the 60-40 portfolio versus the 40% volatility scenarios of the single stock.
Precisely. And it's funny because up until last year, 2022, it's very, very rare to ever see a 60-40 portfolio down as much as like 17%. But that's what we faced when the bond market blew up in 2022. And that was a bit of an anomaly. But outside of that, it's highly unlikely you'll ever find yourself down that much in a 60-40. And if we do, usually like that decline has been somewhat of a waterfall where it's just a precipitous decline. Those things get reversed pretty quickly. So there's never been a prolonged
and the single stock is not doing much better in that scenario usually either.
You're getting punched in the mouth. Yeah, you're getting punched.
All right, I want to finish here with liquidation strategies. And I know that you're able to go extremely deep on these, but for the purpose of today's conversation, talk to me about this term efficacy rating and some of the different strategies in here that you show clients, whether they're Nvidia employees with ESPPs or any other equity comped people from any other companies.
Yeah, so these are the various liquidation strategies that you can use that are legitimate, I should say. I've ranked them by efficacy, which it's purely subjective, so I take the onus on that. But it's based on experience and just empirical evidence gathered over the years of executing on these with different industries, different clients, different risk tolerances. And at the end of the day, I mean, the thing that works the most, and this goes back to that comment I think I made before, is look, 90% of your returns are contingent on how well you behave during times of market stress. If you can just approach it from that standpoint, regret minimization and dollar cost averaging out tend to be the most formidable and the best approaches to liquidating highly concentrated positions.
So you've got dollar cost average out as a 5-star in terms of efficacy strategy, and regret minimization as a 5-star liquidation strategy. Let's start with DCA out. Why does it work, and what is the negative, if any, about doing things that way?
DCA works like the same way it works on the way up, meaning that you're incrementally adding to the account over time. The very same process unfolds on the way out. Now, there can be an externality event. Well, let's say, we go through another 2020 or another 2008. Nvidia wasn't necessarily a big participant in 2008, but we could go through that time period where market prices are just beat to crud, and in that scenario you're still dollar cost averaging out, so you are executing or selling at low prices. Typically, like what we do at the shop is that we'll never sell into a hole, meaning that like if there's a precipitous decline, that's it's sharp and deep, we will not sell into it. We'll wait for the bounce before it comes back up. So everything needs to sort of be taken with a grain of salt. You don't want to be 100% dedicated to that strategy without having some nuance to it. But the dollar cost strategy is also excellent for folks that are considered insiders or control people, because under that scenario, they're better off, and legal will definitely back me up on this at Nvidia, but you're going to want to file the 10b5-1 form and plot out and announce to the market the specific shares, the time and the price with which you will be liquidating to avoid any semblance of insider trading. So that's the other purpose of dollar cost.
So the 10b5-1 report basically says, this is the amount of shares I plan to sell. This is the schedule I plan to sell it on. And that way, the stock has ups, it has downs, it has ups again, it has downs again. But during that period of time, nobody could point at you and say, look at you getting out before the, getting out before the bad news hits. It's like, I told you 3 years ago, this is how I was going to partially liquidate my holdings. Okay, I like that idea. Regret minimization is the other strategy that you think very highly of. Why?
This is the best one. It's just figuring out what you don't want to happen and then just set about avoiding it. So going back to the example we had before, look, if you're a 50-year-old person and you've got 35 to 40 years worth of living expenses across your company stock, obviously seeing that vaporize would be a huge regret. So in that scenario, we can set about planning for how do we make sure that we de-risk these things in a methodical manner that doesn't take them out to the woodshed tax-wise, while simultaneously allows them to participate if markets keep running up a little bit, but acknowledging that there's a level that we need to meet to make sure that we lock in at least this much to forever and the remainder of their time on this earth, that they will never face the probability of where their quality of life suffers. Every single time I can tell you that we've done a regret minimization exercise and then executed on those shares down the road, there's always hindsight. It's a fact of human nature. So that is one of the cons of regret minimization. You will look back and say, damn, I should have sold or should not have sold.
You will regret the regret minimization
yes.
to some extent.
Yes.
Okay.
If you're thoughtful.
That I could believe. So there are a lot of other strategies on here, and we will follow up on these concepts in later episodes, but I want to finish with just an overarching idea here that you have, which is that strategies that don't require you to actively trade and monitor the market on a regular basis, but instead require a more stoic approach, typically net better results. That sounds intuitive. I would bet that's the case. Could you elaborate a little bit more on why that's the case?
I think when you internalize what's really important to you, you stop focusing on the perfect and you just focus on what's going to be enough to make sure that I'm going to be happy. I don't know of anyone who has watched their stock consistently who has a real happy life. I just haven't seen it yet.
Yeah. Well, that you and I as 20 plus year veterans of this industry, we could both agree on. Joey, I want to thank you so much for your time today. I know you spend most of your time talking with our clients and giving advice, hand-to-hand combat, so to speak. So I appreciate you breaking away and doing this. And we'll come back to you for more on this topic. I know it's very important to people working in the technology industry, working at startups. There's a wealth of stuff that we'll get to in subsequent videos. Guys, thank you so much for watching. Special thanks to Joey Fishman, and we'll talk to you soon.